Right now, the silver lease rate has fallen back toward normal, and every trading desk that watches it is treating that as good news. Here's the question you should be asking instead. What if the number calming down is not the market healing, but the market losing interest in a warning it never actually answered? That is the contradiction sitting underneath this entire story. The Silver Institute and Metals Focus are telling you the physical deficit is now in its 6th consecutive year. The lease rate market is telling you nobody's worried about physical silver anymore. Both of those things cannot be quietly true at the same time, and by the end of this video you will understand exactly which one is lying to you. It is Monday, August 3rd, 2026, and silver is trading just above $58 an ounce. That is roughly 51% below the all-time high of $121.62 set on January 29th of this year. 3 data points matter before we go further. First, London 1-month silver lease rates spiked to 39% on October 9th of last year, an almost unheard of level, then eased, then spiked again into the 20s through the autumn. Second, Bank of America raised its 2026 silver price target to $65, with an average forecast near $56.25, explicitly citing the deficit rather than the squeeze. Third, the Federal Reserve under new chair Kevin Warsh left rates unchanged at its last meeting with 3 officials dissenting in favor of further tightening. And the market is now pricing something close to a 2 in 3 probability of a hike, not a cut, at the September FOMC meeting. A hike being priced into a precious metals market is unusual enough that it deserves its own explanation, and we are about to get there. To understand why the lease rate quietly falling matters more than the price falling, you need to understand what a lease rate actually is before you can understand why it moves. A lease rate is the interest a bullion bank charges to lend physical silver to someone who needs metal now and does not own it. Under calm conditions, that rate sits near 0, because there is far more silver willing to be lent than there is demand to borrow it. This only makes sense once you understand the 2 markets sitting on top of each other. There is the paper market, which is COMEX futures and LBMA unallocated accounts, where far more silver is promised on contracts than physically exists in vaults. And there is the physical market, which is actual bars sitting in a vault in London or New York that someone can walk in and take delivery of. Before we get to the consequence, we need to understand the cause, and the cause is the deficit. Every year since 2021, the world has consumed more silver than mines and recycling have produced, and for 2026, that gap is projected at 46.3 million ounces. Think of the paper market as a pressure vessel and the physical vault as the valve. For most of the last decade, that valve barely had to open because paper claims almost never converted into delivery demands. Starting in late 2025, tariff uncertainty around Section 232 investigations froze the normal arbitrage between London and New York because shippers could not be sure metal in transit would not get hit with duties of up to 50% mid-shipment. That froze the valve exactly when squeeze pressure was building, and that is when lease rates first exploded past 30%, because banks that needed to physically deliver metal to satisfy contracts had nowhere fast enough to source it. Silver even traded in backwardation, where the immediate cash price sat above the futures price, which is the market openly admitting it wants metal today more than it wants a promise of metal next month. By the middle of this year, according to reporting from Investor Ideas, that acute squeeze unwound and lease rates normalized, even as the underlying annual deficit kept running at the same pace it always has. That is the mechanism, and once you see it, the current calm reads completely differently. Here is what most of the coverage of this pullback is missing. A squeeze and a deficit are not the same problem, and conflating them is how retail investors get whipsawed. The squeeze was a stock problem, a temporary shortage of metal in the specific right place at the right time, and stock problems resolve when inventory gets rerouted or reclassified. The deficit is a flow problem, meaning every single year, regardless of where existing stockpiles sit, the world pulls more silver out of the ground and out of recycling bins than it consumes, and the shortfall has to come from somewhere. Visible COMEX and LBMA vault levels can rebuild for months while that structural deficit keeps running quietly underneath, because above ground, stock can be relocated or reclassified even while the yearly mining and recycling shortfall never actually closes. That is the part almost nobody discussing this pullback is saying out loud, and it is the reason a calm lease rate today tells you nothing about whether the next squeeze is 6 months away or 6 weeks away. If a video like this is actually changing how you read a data point you thought you already understood, that is exactly the kind of signal worth having flagged before the headlines catch up to it rather than after. Aurelius Metals exists for viewers who would rather see the mechanism early than react to the price move late, and subscribing is the simplest way to make sure the next one of these reaches you while it is still useful rather than after it has already played out. Now back to the analysis, because the more important question is not about the market at all. There are 2 versions of an investor watching this pullback right now. One version understands exactly why they own silver, has a specific thesis built on the deficit, the industrial demand curve, and the monetary backdrop, and has already decided in advance what data would prove that thesis wrong. The other version bought because the price was going up, is now uneasy because the price went down, and is quietly hoping the lease rate calming means the pain is over, without being able to say what would actually make them sell. Neither version is a bad investor to be, but only one of them can tell the difference between a healthy correction and the early stage of a real change in the thesis, and the gap between those two people is not intelligence. It is preparation done in advance, rather than improvised under pressure. If you are not sure which one you are, the honest test is whether you can say out loud right now, without checking the price first, exactly what piece of data would make you change your position. From here, 3 paths are realistic, and the data between now and a specific date will tell us which one the market is choosing. Scenario 1 is renewal of physical stress, confirmed if London, 1-month lease rates push back above 20%, and COMEX registered inventories resume declining, which would likely follow either a reacceleration of the Iran conflict pushing oil and inflation higher, or a formal Section 232 tariff ruling on silver imports, and under that path, a retest of the $80 to $100 range becomes plausible as the deficit reasserts itself against thin available stock. Scenario 2 is a genuine cooling, confirmed if the Fed actually holds or cuts at the September 16th meeting, because inflation data between now and then softens, which would ease the dollar and industrial demand pressure simultaneously. And under that path, silver likely consolidates in the low 50s to low 60s, while the deficit continues to build in the background unpriced. Scenario 3 is stagflation persistence, confirmed if the Fed hikes on September 16th as roughly 2 in 3 of futures traders currently expect, while the deficit data from the Silver Institute's next quarterly update still shows no improvement. And under that path, you get the strangest outcome of the 3, a higher dollar and higher rates failing to break silver because the physical shortage overrides the normal monetary relationship, something we have not seen sustained in modern silver market history. We will not know which of these 3 is actually unfolding until the September 16th Federal Reserve decision, and the data releases between now and then have had time to show their hand, so nothing here should be read as a prediction of which path wins. So here is the question I actually want you sitting with, and it has nothing to do with a price target. If the market can make a genuine structural shortage feel boring simply by letting one borrowing cost number drift back to normal for a few months, what does that tell you about how much of your own conviction in any asset is really built on data, and how much of it is quietly built on how loud the headlines happen to be that week? Leave your answer in the comments, because that is a conversation I actually read and engage with. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk.